Hello friends, this is Vijay Bhambwani here. Welcome to my weekly market outlook video wherein I discuss for the discerning, knowledgeable and statistically aware traders as to how the market is looking. A fortnight ago when I put up this thumbnail that you see on your screen that the Indian markets are likely to outperform the global markets, and last week when I put up a video saying FOMO or fear of missing out is going to push up our markets to a new high. Many of you thought I was off my rocker. There was a lot of interesting, juicy feedback and comments on my YouTube video, my social media accounts, etc. Pretty amusing. Keep it coming, guys. I really love hearing your feedback, good, bad, or ugly. But what does it look like from here onwards? Should it be prudent to book profits? Should you have anything to worry about in the light of the fuel crisis, in the light of emerging facts that inflation is likely to be more than transitory, and more importantly, what do you do with your portfolio? So stick with me to the end of this video because I have a special segment just as I did last week at the fag end of this video, wherein I will take a deep dive into whether you have something to be worried about. That's coming at the fag end of this video. Let's dive right in as to what the market was last week and what you can expect in the coming week. So on your screen now is the market roundup chart here, which basically tells you that the Bank Nifty is outperforming the Nifty 50, and why it did so we will discuss in a bit. Bullion rose a tad on inflationary concerns. Oil continued its climb and gas corrected a bit. The Dixie, which is the US dollar index versus the global basket of currencies, eased marginally because inflation was finally seen as not so transitory. Transitory would mean temporary. Deliberately. I'm coughing deliberately because I have been debunking the transitory inflation theory for many quarters now on my social media pages. Those of you who are connected with me on social media will know how I've been very skeptical about that school of thought which says inflation is here only temporarily. Now, do connect with me and we'll get conversations going. My contact coordinates of my social media accounts come at the fag end of the video. Now, the US dollar against the Indian rupee rose a bit, and that was a marginal cause of concern. The Indian 10-year benchmark bond yield rose because the inflationary concerns again triggered some concern in the bond market, and we'll handle this in the bond segment which will follow very shortly. On your screen now is the MWPL, or the market wide position limits, the overall market open interest, which rose to 31.91%. Now, a rising open interest market-wide MWPL is a pretty routine phenomena. That's nothing to be really alarmed about. But coming as it does, in the wake of inflationary concerns, in the wake of the fuel crisis, it's pretty noteworthy. And if the MWPL was to cross 35% and stay higher than that, I would expect the markets to continue to make higher highs. Now, I want to discuss something in behavioral finance for those of my viewers who are very keen that I discuss neurobehavioral studies because I pioneered this many years ago when I used to be a consulting trainer at the Multi-Commodity Exchange. Now, behavioral science calls a phenomena the marshmallow test, wherein children were shown a jar of marshmallows and they were given an option. They were given an option that they could either take one marshmallow right away and walk away, no encumbrances, no conditions, or they could wait for an hour or two and get two marshmallows. Guess what? Majority, I would say almost all children, preferred to take one marshmallow and go away. Now, the very, very patient investor trader who is waiting for a while longer to get higher rewards is called a two marshmallow trader or a two marshmallow player. Now, what the MWPL tells me is that these guys are opening a new long position and willing to roll over their trade to the next trading session, willing to write out a check. Check is of course symbolic. Nowadays there's online transfer. Willing to write out a check and saying, look, I'm going to dig my heels into this trade and I'm not squaring it up till I get my desired returns. All right. Now, these are the two marshmallow traders. So if the MWPL goes up above 35% and stays higher, and MWPL historically rises up to the third week of the derivative cycle, I would say that the number of two marshmallow guys, traders who are rolling over their long positions overnight, far outnumber traders who are one marshmallow guys, people who are squaring up their transactions on an intraday basis. Now, do not forget the one marshmallow versus the two marshmallow analogy. Nowadays, these markets are increasingly becoming a two marshmallow markets. Now, where do you get these MWPL figures every day? Simple, on my social media accounts. So, which is why I tell you, do connect with me, because I put up a lot of market related updates. Very simple terms where a high school, secondary school student can understand what's happening in the market, and I'll help you trade better. Let's take a look at the stock futures and the index futures volumes data chart. Do remember, these are cumulative figures for 3 consecutive series, which is October, November, and December. Now, these show that the volumes across the board have perked up, and the index, the stock futures volumes have actually hit a 10-session high because trader participation perked up. And when traders prefer to take higher exposure in individual stocks, it shows that the risk appetite has grown. The index futures volumes also perked up a little bit, which is also a welcome development. Let's now take the basis chart. Now, what is the basis? The basis is nothing but the futures premium over spot. Now, this shows that the Nifty basis expanded, which means remained buoyant on a week-on-week basis, whereas the Bank Nifty saw basis contracting, which means the futures premium fell over spot on a week-on-week basis because dynamic hedges took place here on the Bank Nifty. This is when traders go long on the constituent stocks which make up the Bank Nifty, and they go short on the sectoral index, which is the Bank Nifty, to cover their tail risk hedge. This is a very common tactic used by hedge funds worldwide, and the Nifty basis rose because short covering was seen and bears got squeezed above the 18,000 mark. Now, let's come to the showstopper, our in-house exclusive study that you won't find anywhere else in the public domain, and something that I have been basing my very, very aggressive new market high calls and markets outperforming the Asian market peers. Yes, I'm talking about the impetus chart. Last week, I said that I would ideally want the indices to rise with rising impetus, which the markets gave us. Voila! Look at the impetus chart. It's simply zooming up exactly like Jeff Bezos's space rocket, the Blue Origin. Now, as long as the impetus goes up, the bulls are in command, and therefore we must be watching this indicator every day even more carefully, because this is where signs or early signs of reversals will appear first. Now, which is why you should connect with me on social media, because I update all this data on a day-on-day basis. Now, the impetus is on a period high, and like I said, we'll keep a hawk eye on this indicator on our dashboard. And Let's now see the footprint of various types of market participants. We first start with the FIIs, and the FIIs show their index futures net long positions are higher on a week-on-week basis to 51,720 lots, which was last week 22,365 lots. The stock futures are marginally lower at 84,912 lots, which was last week 1,18,295 lots. The DIIs, the domestic investment institutions, have reduced their index shorts to 75,892 lots, which was last week at 80,427 net short. Even their stock future shorts are marginally lower at 12,87,052 lots, which was a net short of 12,93,756 lots. So the DIIs seem to be covering their short positions a bit. Now let's take a look at the prop traders. Now these are traders who are brokers initiating their own individual proprietary trades. These guys are second best to insiders because they know who's buying, who's selling. After all, the trades are taking place through their brokerage firms. So the prop traders have stepped up their index net shorts to 27,085 lots, which was last week at 13,739 lots. Their stock futures long positions have gone down to 1,91,031 lots from last week's 2,06,838 lots. So the prop traders are booking profits marginally. Now come the retail traders. These are people who've been powering the rally so far. Retail traders have booked profits on their index net longs, and they are now at 51,256 lots, which last week was 71,801 lot. And their stock futures longs continue to go higher and higher, standing at 10,11,109 lots, which was last week at 9,68,623 lots. So it's very clear that the retail risk appetite is continuing to rise. Qualitatively speaking, the proprietary traders are a bit cautious, but retail guys remain as gung-ho as ever, which simply means that retail traders are more emotional and sporadic. That means the volatility in the market is likely to go up. Now, this is something that you need to be careful about. So, like I said, the retail has been powering the rally so far. Will they continue to power the rally from here on? We're going to have to wait and watch. And a reminder again, do not go away. At the fag end of this video, I'm going to discuss whether you should be booking profits or if there's something that you should be worried about. Now, friends, let's go to the 10-year benchmark bond yields, which continue to remain firm in the upper end of the 6-monthly band. The Reserve Bank of India has announced an end to the GSAP, which is Government Securities Acquisition Program, which might be initiated if and only if there is an SOS or an emergency. And the RBI is to resume its borrowing plan, which the Honorable Finance Minister has laid out in the budget of 2021 to the extent of 12 lakh crores, of which approximately 7 lakh odd crores is done. So 5 lakh odd crores still needs to be borrowed from the bond market. And the markets are expecting interest rates to firm up from here onwards, which is why the yields are firming up. Now, this is, of course, one of the many reasons why the bond yields are firming up, but an important one nevertheless. We are going to keep monitoring the 10-year benchmark bond yield to keep our ears to the ground, because much of your returns, even on your debt funds, will depend on this indicator. And it will also determine the movement of capital from the bond funds to the equity funds, which means directly or indirectly, this will impact even equity price movement. So let's watch this indicator very, very keenly. Friends, let's now come to the US dollar index, the DXY, which is the US currency benchmark vis-a-vis the global basket of currencies. This saw a net fall on a week-on-week basis, as you can see on your chart, especially after the big fall on Wednesday when inflation started to worry the traders. The index has fallen on 3 out of 5 trading sessions, but it stayed above its 25-day exponential moving average, which means the short-term outlook remains positive for now. The 93.5 level that I used to mention for many weeks still remains defended. This is marked by a dashed red line. As long as the bulls keep the index above this threshold, the trend remains intact. On your screen now is a weekly chart which shows an inverted hammer near almost a 1-year high. This is also due to the sticky inflation partially. Now, for the rally to resume again, the 94.5 level needs to be overcome forcefully, and the price must sustain above this 94.5 threshold. On the weekly chart, the price remains above the 25-week exponential moving average, which means even the medium-term outlook remains positive for now. Last week, I advocated a range between 95.10 on the upside and 93.10 on the downside, which held perfectly well. Next week, I expect an estimated range between 94.95 on the upside and 92.95 on the downside. Watch this index very keenly in the coming weeks because a lot of things, including bullion, equities, bond yields, etc., will depend on the movements of the DXY. Friends, let's now go to the Bank Nifty, which gained 4.14% on a week-on-week basis and in the bargain outperformed the Nifty 50. And the RBI announcement, which of course I'm going to take in greater detail about convertibility, lifted sentiments for the Bank Nifty. I'm going to discuss this in the last segment of the video, which I promised you must watch, about whether you have anything to worry about in the markets. So that factor on convertibility lifted sentiments. This index rose on 5 out of 5 trading sessions and in the bargain stayed above its 25-day exponential moving average. And this moving average, as I've told you in my past videos, denotes the holding on cost for approximately a month-old time frame. As long as the current market price stays above the monthly price average, bulls are incentivized to hold their long positions. Simple. The Bank Nifty is now in blue sky territory, which means it's at a new all-time high. There is no overhead supply coming from bulls who are trapped at higher levels and therefore waiting to exit in nervousness. And if any further up move occurs, short covering itself will fuel fresh upsides and therefore downsides can be limited. But you will need to watch the impetus and the basis on a day-on-day frequency. This is why I tell you to connect with me on social media so I can update you on a daily basis, because if at all a reversal is to come, it is on the impetus chart, it will show up first. And the weekly chart on your screen now shows a big, powerful, bullish candle that has taken the index. Like I said, it was in the blue sky territory. A routine pause after such a powerful upthrust should not really worry traders as long as the impetus does not fall too much. The price remains above its 25-week exponential moving average, which many people take very lightly. The people ignorant about the dynamics of the market say that the 25-period exponential moving average is antiquated as a study, but on a weekly chart, 25 weeks tells you that it's a 6-month holding period. So as long as the price remains above a 6-month average, even the medium-term bull is incentivized to hold on to long positions, which means the outlook is positive. Since the price is kissing the upper trend line of the weekly chart, some routine profit taking is along expected lines. As long as declines in prices are on low volumes and open interest does not change too much, I think you should not really be worried too much. The week before last, this index was number 68 on the NSE FNO statistical beta list. It climbed very rapidly to number 5. Now that's some doing. As you can see, the statistical correlation between beta and the impetus is extremely tight. Now, this kind of volatility raises the risk for retail traders, so I would suggest, my friends, that you trade light with strict adherence to your stop losses. Last week, I advocated a range between 39,150 and 36,400, which was exceeded on the upside because the weekly high was 39,375, which is 225 points higher than where I was expecting some resistance. But coming on a base of 38,000 odd, it was less than a percent. But to be fair, the price did exceed my target by 225 points. And this was due to the strong impetus that you saw. In the coming week, I expect an estimated, I repeat the word estimated, range between 40,725 on the upside and 37,950 on the downside. I repeat, my friends, please trade light because the beta or the volatility is extremely high. Friends, let's now come to the Nifty 50, the most liquid, low impact cost futures and options traded instrument on the NSE derivatives segment. Now, this index rose 2.48% on a week-on-week basis, and it rose on 5 out of 5 trading sessions, as you can see on your daily chart on your screen. And there are gaps in the rally. Now, this shows a very emotional runaway up move and something that tested the upper trend line of the bullish channel. That can be a valid reason for a pullback for the bulls to take a breather. I think so. And as long as the impetus, like I told you in the Bank Nifty's case, does not fall too sharply, the volumes are not very high on declines, and the open interest does not change much, I would count it as a routine corrective pullback. Here, the price remains above its 25-day exponential moving average, which means the current market price is above its monthly average holding on cost for the bulls. And therefore, the bulls are under no compulsion to book profits. And here again, this is a new all-time high, so the index is in blue sky territory. No trapped long positions are waiting for the upside to get out, and that's a positive sign. Let's now switch to the weekly chart. And the weekly chart shows a prominent bullish candle which has taken the index to new highs. The low of this candle, the weekly candle, is at 17,839. Now, this will be a very interesting momentum support for extremely short-term traders. As long as the price remains above this level, I think the bulls are, even the very short-term bulls are in control of the situation. Here again, the price remains above its 25-week exponential moving average, which is a 6-monthly average holding on cost. As long as the current market price is above this level, the medium-term outlook is also positive for now. The fuel and coal crisis falls under what I call the known known. In behavioral finance, a known known is something that the market already knows and therefore has discounted it. It cannot derail the upthrust single-handedly by itself. But I do suspect if any unknown, which means a sudden and unforeseen situation coming in, can trigger a fall. We don't know anything about that sort yet, but I'm just merely warning you what can trigger a fall. So even then, even if there is an untoward, unforeseen circumstance, a news trigger that you've not really bargained for is hitting the markets, do read the impetus chart. This will be the first and foremost warning that the markets want to dive. As long as the impetus does not fall too much, I think there's nothing to worry at all. This is why my videos stress so much upon statistics, mathematics, because mathematics cannot be fooled around with, it cannot be manipulated, it cannot be influenced, and there are no emotions. All right. Now, in the week before last, this index was number 81 on the statistical beta list on the NSE F&O space, but it rose very, very sharply to number 12. Now, that's a quantum jump. And this is because the impetus skyrocketed last week. Now, this statistical correlation is extremely important to note for all of my friends who are systems-based traders. Last week, I advocated a range between 18,350 on the upside and 17,450 on the downside, which I'm very proud to say about my statistical trading model, the IBEX, was on the dot because the Nifty high was 18,350.75. Next week, I expect an estimated a range between 18,800 on the upside and 17,875 on the downside. I repeat, 18,800 on the upside and 17,875 on the downside. Now, I would say you continue to trade light due to the rise in statistical beta in the Nifty as well, and hold your long positions with stop losses in place, and do continue to trade light. Friends, that's done. Now I have two segments left. First one, in which I'm going to give you 5 stocks with high beta, high impetus, where they've gained volatility on a week-on-week basis, where you take a small exposure and wait for big price moves, and 5 more stocks which are low beta, low impetus, where you take big exposure and wait for small price moves. Why the difference? Because different traders, different techniques, and different time frames and mindsets, and therefore different trading tools. Now I start with high beta, high impetus stocks, which gained on a week-on-week basis where beta is concerned. The list is led by SRF at number 1, number 2 Adani Ports, number 3 Tata Motors, number 4 Tata Chemicals, and number 5 APL Limited. Low beta, low impetus stocks, the list is led by L&T Finance, number 2 India Cements, number 3 Emphasis, number 4 Indian Oil Corporation, number 5 IDFC First Bank. Friends, this hierarchy can change hour to hour, so therefore it is important that you monitor as to what is happening on a day-on-day basis, which is why you should connect with me on my social media pages so I can update you on a day-on-day basis. Now, the other segment that I promised you I had left was whether the market is likely to get spooked and whether you should be booking profits. Now, let's discuss why the markets can be enthused and why they can be spooked out. Last week, I gave you a list of what's hot, what's not. I begin with that. Let's take a look at what can pull the markets even more higher. The RBI, the Reserve Bank of India, has hinted that capital account convertibility may be brought in the country. It's basically told the banks to be prepared for full convertibility. This is a big factor. This is something that the overseas investors have been asking for since many years. The government has hinted that it may push this reform in the near term. Now, this has big implications for the markets and citizens both. Forex markets will have to trade longer working hours because you can't just shut at 5 p.m. There are going to be foreigners who are coming out to hedge in the market, which means you will have more and more currency trades taking place onshore rather than the NDF market, the non-deliverable offshore market. The LRS, which is the liberalized remittance scheme, will need tweaking, probably upwards, or may even be scrapped. Of course, I'm conjecturing here. I have no proof of what I'm saying. I'm just conjecturing. And the forex markets might get a little more volatile. So the RBI will be a lot more proactive in the forex market trading. Now, this is one of the biggest reasons rather why the Bank Nifty rose last week. A lot of people are ignoring the behavioral aspect of trading, the neurobehavioral aspect of trading, to be even more precise, that the cause and effect theory has a big bearing on the markets, and unless you understand the cause, you can never gauge the impact. Then There is another positive which you need to look at is that the Chinese turmoil in the bond markets with Evergrande, Sinopec, etc., others defaulting on their credit repayments, the money has now started coming into the Indian bond markets. After Air India, more public sector units are to be divested. COVID vaccines are proceeding at a very rapid pace. And to the relief of industry, coal companies are in the process of stepping up their output. And after a few more weeks, we are told that this crisis of shortages may just be addressed sufficiently enough for the markets to heave a collective sigh of relief. Now, FTAs, free trade agreements with the United Arab Emirates, UK, European Union, and Australia are under negotiations. Friends, I, in my previous video, gave you 3 reasons why the markets will hit a new high. The Comprehensive Economic Agreement, the CEPA, Partnership Agreement, the listing of the Indian bonds in overseas bond indices, which would result in $20 to $40 billion of inflows per annum for the next 10 years, and the opening up of the government securities market for the retail investor was something I told you last week. Now, in continuation of that, when you talk about the FTA, free trade agreements, now here are 2 countries which are signing FTAs, and they are saying we can import and export goods to each other without the applicable custom duties of each other's countries, which means cheaper flow of goods and services, which means India's exports are likely to rise. This is something that a whole lot of people are not taking into account before trolling me that you are talking about the market going up in spite of so much negativity. You're entitled to your opinion, I'm entitled to mine. I would look at hard facts and numbers and statistical data that my in-house model throws up at me. So cool guys, you take your position in the market, I'm going to take mine, right? So the big ticket reforms are something that the FIIs are not going to take lightly. They're going to react to them. They're going to put money where their mouth is, and the bullishness to that extent is something I continue to expect to prevail in the markets. Now let's take a look at what can worry the markets. If oil and gas prices spike higher, that can worry the bulls, I admit. If the United States dollar rises sharply, that can trigger worries in emerging markets, including India, because hey, we are import dependent. 2/3 of all our imports are fossil fuels, and fossil fuels are inflationary. And the bond yields are telling me that interest rates may rise in the coming months, but it doesn't look like something that's imminent. It's not going to happen tomorrow, day after, or even next week or next month, but it's something that weighs on the market's mind. And net, I feel that the markets are going to focus more on the positives, less on the negatives, and therefore, no, I don't think you should panic and surrender your long positions. Should you be concerned? Yes, I think the global crisis in fuel and inflation and of course the supply chain disruption is something that you need to worry about. You can definitely take protective action by keeping protective stop losses on your long positions, but should you dump everything you have so that you can get better sleep at night? I think that would be a mistake. All right. So all the worries that we saw in the negatives in the graphic above are already in the public domain. Now, these behavioral science calls the known knowns. What we can worry about is something, of course, we have no control over. These are unknown unknowns, sudden, unexpected events. That, of course, like I said, nobody has any control over. But even then, I think statistics will help us out by telling us whether the impetus of the broader market is falling. As long as the impetus is not falling too much, I think the markets will take a hit, they will take the punch on the chin, and they'll pick themselves up, rise up again to box again. So statistics will help us and guide us even in the coming week, although it's not going to be a walk in the park, it's not going to be easy, but So far, the impetus is zooming, and we'll keep looking at it on a day-on-day basis. So hold on to your longs, hold them with stop losses. Sentiments continue to remain optimistic. And do remember what I told you about the two marshmallows. The market currently is in a expanding risk appetite mode. It's taking two marshmallows rather than one. And it's not just day traders, but people who are initiating long positions and carrying them forward to the next week who are ruling the roost. Friends, I come to the end of my video, not before reminding you, if you liked what you saw, please subscribe to my YouTube channel. Do share the video with your family and friends. Help me reach out to fellow like-minded traders. Subscribe to my YouTube channel. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And in the description below the video is a hyperlink to my YouTube playlist on Equity Master, wherein I put up a couple of videos every week. To subscribe to that playlist also. There is also a link to acquiring a free trading guide from Equity Master. Do avail of this fantastic offer and help yourself become a better trader. Friends, I thank you for your patience and watching my video. Slightly longer one this week because of the special segment. I wish you have a very, very profitable day. Coming up next are my contact coordinates. Do connect with me on social media if you want to update yourself with all the data that I put up out here. Have a very profitable week. Thank you. Take care. Bye-bye.